All right, let's cut through all the noise you hear about the stock market. Forget about trying to pick the next hot stock or timing the market perfectly. In this explainer, we're going to build a simple, powerful investment strategy that's based on one core idea. Let's dive in. We've all heard this, right? Usually when we're talking about gambling. It's the simple reason why casinos in Vegas are always profitable. Well, the central idea we're digging into today is that the stock market, it actually operates on a very similar principle. You see, the odds are mathematically stacked against you, the individual investor, if you're trying to beat the market. But in this game, the house isn't some casino. It's the massive financial firms. They've got the resources, the speed, the sheer scale. So trying to outsmart them is like trying to outsmart the casino. It's a game you are pretty much designed to lose. So if the game is rigged, how in the world are you supposed to win? Well, ironically, the best way to understand good investing is to start by studying what makes a bad investor. We're going to learn from the common emotional mistakes that almost everyone else makes. So let's meet the classic bad investor. This is the person who gets a hot tip, sees a stock going to the moon on social media, and moves their life savings into a trading app. They're not driven by data or logic. Nope, they're driven by hope, by hype, and by fear. They don't just invest their money, they invest their emotions. And that, my friends, is an absolute recipe for disaster. And what's so fascinating is how predictable this all is. There's a life cycle to it. It starts with a huge all-in bet, then comes some half-baked theory for why it's a sure thing. But here's the real kicker. It doesn't even matter if they win or lose at first. If they lose big, they chase their losses, trying to make it back. If they get lucky and win, they think they're a genius and try to repeat that lightning in a bottle moment. The end result is almost always the same. They lose it all. And this quote just nails it, doesn't it? The difference between someone who doubles their money on a meme stock and someone who loses everything, it isn't skill, it's just luck. Picking one winning stock doesn't make you an investing genius, any more than winning one big bet on red makes you a professional gambler. It just means you got lucky that one time. Okay, so if we've established that trying to pick individual stocks is basically just a gamble against the house, what are we supposed to do? What's the real alternative for actually building wealth over the long term? All right, let's get to the solution. And it all starts with a huge shift in your mindset. We have to stop searching for the best investment and start looking for the optimal one. Now, they sound similar, I know, but trust me, the difference is absolutely everything. See, chasing the best investment is trying to find the next big thing before anyone else does. It's a gamble. Optimal investing, on the other hand, is the opposite of a gamble. It's a strategy that's based on decades of historical data, math, and solid research. It's designed to give you high expected returns with relatively low risk. It's not about getting lucky, it's about playing the long game intelligently. And this brings us to the hero of our story, a man named John C. Bogle. He's the founder of the investment company Vanguard, and his whole philosophy is credited with saving everyday investors an estimated $1 trillion in fees. Yeah, trillion with a T. He's the one who figured out how to turn the tables and give the edge back to us. So how did he do it? It was actually kind of genius. He created this revolutionary structure at Vanguard, where the company isn't owned by outside stockholders looking to make a profit. Instead, it's owned by its own funds. And what that means is that the profits, instead of going into the pockets of the firm's owners, are used to lower the fees for you, the investors. He basically made it so the company's goals were the same as its customers' goals. Bogle's entire philosophy is built on one simple, powerful truth. While any single stock is wildly unpredictable, the market as a whole is remarkably predictable over long periods of time. For decades and decades, the U.S. stock market has delivered an average annual return of right around 10%. The goal isn't to beat that number, it's to simply capture it with as little cost as possible. And this chart here lays out the classic trade-off perfectly. You could keep your money in cash, sure. It feels safe, low risk, but inflation just eats away at its value. Bonds give you a little more return for a little more risk, but historically, stocks have given the best bang for your buck, the best risk-to-reward trade-off for long-term growth. The key is to manage that risk, not try to avoid it completely. So let's put all these pieces together. We have the philosophy, we understand the numbers, so what's the actual practical strategy? Let's look at the blueprint for optimal investing. Here it is. It's often called a passive three-fund portfolio, and it is beautifully simple. You just own a piece of the entire U.S. stock market, a piece of the entire international stock market, and then a slice of the bond market for some stability. That's it. That's the whole playbook. No stock picking, no trying to time the market, no chasing hype. And why does this ridiculously simple approach work so well? Well, think about it. You're not betting on a single company to succeed, you're betting on the entire global economy to grow over time. By using index funds, you keep your fees incredibly low, so more money stays in your pocket. The bonds act like a shock absorber when the market gets bumpy. And most importantly, you just let the magic of compound growth do all the heavy lifting for you over decades. So the crucial point is this, and it might sound totally counterintuitive after everything you've probably ever heard about investing. The goal is not to become a slick day trader, glued to your screen, buying and selling every 5 minutes. That's the gambler's game.
No, you want to be the person this slide is talking about, the one who makes the day traders mad. The person who invests consistently, month after month, ignores all the noise, and ends up outperforming almost everyone else in the long run by doing less. The ultimate goal isn't figuring out how to win the game. It's about setting up the rules so that winning becomes almost inevitable.